If you have $1,000 in your bank account right now, you are actually wealthier than roughly 47% of Americans. But here is the uncomfortable truth. That still is not enough to protect you from the next market crash. Because historically, when the stock market falls hard, the average American investor loses between 30 and 50% of their portfolio value before they even realize what is happening. And here is the interesting part. Before every major crash since 1987, the S&P 500 has flashed the exact same warning signal. 1987, 2000, 2008, 2020, same signal, same pattern. And today, parts of that signal are starting to appear again. So in this video, I am going to show you the S&P 500 indicator that has historically appeared before major market crashes, why most investors completely miss it, and 3 practical steps you can take starting this week to protect and grow your wealth, regardless of what happens next. Because the real goal is not predicting crashes. The goal is being prepared before they happen. Now at US Wealth Academy, our mission is simple. We help everyday professionals and small business owners build long-term wealth using data-driven investing principles. Not hype, not speculation, just clear financial frameworks that actually work over decades. Many members of our community have built substantial portfolio growth by following a simple philosophy. Markets rarely crash out of nowhere. They weaken first. And if you know what signals to look for, you can often see that weakness forming long before the headlines start talking about a crisis. Today we are going to break down one of the most consistent signals in modern market history. But before we talk about the signal itself, we need to understand the mistake that costs everyday investors tens of thousands of dollars. Most people believe market crashes happen suddenly. They think one day everything is fine, and the next day the market collapses. But that is not how markets usually work. The real issue is that most investors only look at one thing: price. If the S&P 500 is going up, people assume the market is healthy. But price alone can be misleading. Before the dot-com crash in 2000, the S&P 500 was hitting record highs. Before the 2008 financial crisis, the market reached another all-time high in 2007. Even in early 2020, just weeks before the pandemic crash, the market was rallying strongly. So price was not warning investors. But something else was. The hidden cost of ignoring these signals can be enormous. During the 2008 financial crisis, the S&P 500 fell about 57% from peak to bottom. That means a $200 portfolio dropped to roughly $86,000. For many families, that represented more than a decade of savings temporarily erased. And unfortunately, many investors panicked and sold near the bottom, locking in those losses permanently. Another problem is that the financial system rarely teaches people how to recognize early warning signs. The industry often focuses on selling investments rather than educating investors about risk signals. At US Wealth Academy, we believe real financial education should include both growth and protection. Which brings us to the signal that has historically appeared before many market crashes. It is called market breadth deterioration. Market breadth simply means how many stocks are actually participating in a market rally. The S&P 500 contains 500 companies. In a healthy bull market, most of those companies move upward together. But before many crashes, something unusual happens. The index keeps rising, but fewer and fewer individual stocks are actually going up. In other words, the market appears strong on the surface, but underneath it is weakening. For example, before the dot-com crash in 1999, a small group of technology companies drove the majority of the market gains. Meanwhile, hundreds of other stocks were already declining. Before the 2008 financial crisis, many financial stocks were already weakening months before the overall market peaked. This kind of internal weakness is often tracked using indicators like the advanced decline line, or the percentage of stocks trading above their 200-day moving average. When those indicators begin to fall, while the index itself keeps rising, it can signal that the market is becoming fragile. Another related warning sign is concentration risk. This happens when a small number of companies begin to dominate the entire market index. For example, in recent years, the top 7 companies in the S&P 500 have represented close to 30% of the entire index value. Companies like Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, and Tesla have driven a huge share of market gains. These are extraordinary companies with strong businesses, but when a handful of stocks carry most of the market's weight, the system becomes more sensitive to changes. If just a few of those companies experience sharp declines, the entire index can move lower quickly. Historically, we saw similar concentration patterns during the late 1999 tech bubble and during the 1970s era known as the Nifty 50. Both periods were eventually followed by major market corrections. Now, this does not mean a crash is guaranteed. It simply means the level of risk in the system may be increasing. And this is where smart investors approach the market differently. Instead of trying to predict exactly when a crash will happen, they build systems that allow them to stay invested while managing risk. At US Wealth Academy, we often describe this using something called the wealth ladder. Think of wealth building as climbing a ladder with several levels. Each level strengthens your financial position. The first level is financial stability. Before aggressive investing, it is important to build a safety foundation. That usually means having 3 to 6 months of living expenses saved in an emergency fund. If your monthly expenses are $4,000, that means saving between $12,000 and $24,000 in accessible savings. This protects you if markets fall or if unexpected life events occur. The second level of the ladder is core investing. This is where many people begin building long-term wealth through diversified investments. Many investors use broad index funds that track markets like the S&P 500, total market funds, and sometimes international diversification. Historically, the S&P 500 has produced average annual returns around 10% over long periods of time. But those returns include multiple large market corrections along the way. That is why consistency and diversification matter. The third level of the wealth ladder focuses on risk awareness. Once your portfolio grows past $50,000 or $100,000, managing risk becomes increasingly important. That includes periodically reviewing your asset allocation, avoiding extreme concentration in a single sector, and rebalancing your portfolio every 6 to 12 months. These simple habits can help investors stay disciplined during both market booms and market downturns. Let me give you a simple example. Imagine someone named Sarah. Sarah is 35 years old and invests $500 per month into diversified index funds. Over several years, her portfolio grows to about $120,000. At some point, the market experiences a correction, and her portfolio temporarily falls to $95,000. Instead of panicking, Sarah continues investing consistently every month. Because she keeps buying during lower prices, her long-term results improve. 5 years later, her portfolio grows to more than $210,000. The lesson here is simple. Consistency and discipline often matter more than perfect market timing. Now, some people watching might still have a few concerns. The first common objection is not having enough money to invest. But investing does not require huge amounts of capital. For example, investing just $300 per month at an average 10% return for 25 years could grow to more than $350,000. Small contributions become powerful when combined with time and compound growth. Another concern people often mention is not having time to analyze markets. The good news is that most long-term investors do not need to spend hours every day studying the market. Many successful investors simply review their financial plan once every few months. Consistency and patience usually outperform constant trading. And the final concern people raise is risk. Yes, markets involve risk. But avoiding investing entirely can also be risky because inflation slowly reduces the purchasing power of your savings. The goal is not eliminating risk. The goal is managing it intelligently. And remember, this is financial education, not personalized financial advice. Always consult a licensed financial professional for your specific financial situation. Now, if you want to take the next step in your wealth journey, here is a simple exercise. Identify where you currently stand on the wealth ladder. Are you still building financial stability? Are you in the core investing stage? Or are you focusing on advanced wealth building and risk management? Knowing your current level makes the next step much clearer. And I would love to hear from you. Where are you right now in your wealth journey? Beginner, intermediate, or advanced? Share it in the comments below. Because wealth building is not about overnight success. It is about understanding the signals, making disciplined decisions, and steadily climbing the ladder over time. And here at US Wealth Academy, that is exactly what we are here to help you do.